So a reverse mortgage, in my book, as a professional in the business for 40 years, is really like one of the most important tools in your toolbox. Now, true disclosure, I don't really use tools. I have a son-in-law who hangs pictures for me if I need something, or I hire a guy on Fiverr to help me. But the idea is that a financial advisor, if you're going to really look at somebody's holistic package, how do we help somebody get to where they want to go, or from A to B in a certain plan? There's all kinds of tools you can use, stocks, bonds, and fancier products. And one of the tools in the toolbox that's very underutilized, which is why I launched this podcast, is reverse mortgage. We're excited to have here somebody who's had a career in financial advising as a financial advisor. He now is at the corporate office of one of the largest reverse mortgage lenders in the country, and one of the best for my money, CrossCountry Mortgage. Brady Mullen, thank you, Brady, for joining us today.
Thanks, Bill. Good to be here.
So what's your official title at CrossCountry?
Oh, it's some business development. It's what they call people that they don't know what to call them. It's like divisional business development manager or something like that. Yeah.
I love it because within the corporate office is a big deal, but the rest of us like whatever. He's a mucky muck of some sort, whatever he is.
Yeah.
I didn't really. So I know you had a career, and we'll get to a little bit to your story as a financial advisor. Where do you see the unique opportunity for reverse mortgages to fit into a financial advisor's toolkit to help them be more successful at their business?
Well, it's kind of a progression. It was for me. So at first, probably like most financial advisors, I'm kind of open-minded until I hear more about it. And so when I remember hearing about reverse mortgages, I was first exposed to it when I was in a CE class. It was sponsored by some reverse mortgage originator, and it was a CE class about long-term care, if I remember right. And he just kind of told me about it, and I was like, I've heard of those, but that sounds different than what I remember. I should look into that. And it still just kind of got backburnered in my mind, and I remember just kind of it just wasn't urgent at the time, but I remember thinking, oh, that's different. And I referred a couple clients who I thought could have used it. And I was kind of where a lot of financial advisors are, where we hear people say, well, I can see how that would be the right fit in the right scenario. I can see, it's not right for everybody, but I could see it fitting that scenario. And that's where I was for a while. And then, gosh, I became more and more educated about it and started to understand it more and more. And this is while I was still a financial advisor. I wasn't working for CrossCountry at the time. I was running a practice. And I got to the point where I was like, wow, all you're doing with this is turning an asset that's illiquid into an asset that's liquid. And all things equal, that's just a good thing. I got to the point where I thought, well, unless you're planning on leaving the home soon, in which case you wouldn't want to pay the cost of any kind of refinance, traditional or reverse or otherwise. But I thought to myself, why would anybody choose to have an asset that could be liquid, illiquid? That doesn't make any sense.
Right. And so there's a number of reasons why. Now, I'm a probate and estate planning real estate broker. So I deal with we didn't have any liquidity, we need some, we have to sell a piece of property. Whereas had they had a reverse mortgage, at least they could have, with the excess usage, or take a reverse mortgage, put the money into liquid assets, they would at least have those assets available. So I'm kind of the after, we didn't plan ahead of time to have enough liquid assets case. As a financial advisor, your job is to prepare. So let's talk about some of the cases where somebody might need liquid assets that are unexpected. What are examples where somebody all of a sudden needs to have access to liquid assets they didn't plan on before? What are the common cases?
Yeah, like pick a scenario. Earlier than expected death, and you lose half of Social Security in retirement, or long-term care needs, or a kid with special needs, or you don't have kids, or your kids are independent financially, and you want to just spend some of the wealth that you've spent a lifetime building up. One of the major downsides of real estate as an asset in general is that it's illiquid, relatively illiquid, right? You can buy or sell real estate, but it takes a lot of time, takes a lot of money, and you can't sell parts of it, right? So if you want $10,000 worth of some real estate that you own, whether you live there or whether it's an investment, that's tricky to access because you can't sell $10,000 worth of real estate. And so the way they make that liquid is through lines of credit against that property. And the one knee-jerk reaction that a lot of people get, financial advisors included, and I was in the same boat until it kind of dawned on me, is that, well, they'll say, yeah, you can get access to the value there, but you're paying interest on anything you pull out. And the more I thought about that, I thought, well, yeah, but you still control the asset. So like life insurance policies are built this way fundamentally internally. Yes. in a permanent life insurance policy. You don't distribute the asset because it's tax efficient to leave it there. You borrow against it, but because you still own the asset on your balance sheet and you borrow against it, your balance sheet doesn't care that you did that. It's as if you sold some of the asset and you no longer have access to its future growth. But because you didn't sell it and you do own its future growth, the fact that interest is accruing on the line of credit is okay. It's the equivalent fundamentally of selling a portion of the house piece by piece, which is brilliant. Like it cuts. It makes one of the worst attributes of real estate ownership, which is illiquidity. There's lots of good things about real estate ownership, by the way, but that's probably its weakest link. And it just takes that off the table because now the equity, or at least a portion of it, it's not 100%, but a portion of that equity is completely liquid and you can use it piecemeal.
And even that portion, if you could sell it, you'd have to pay taxes on it typically. And with the reverse mortgage, you don't pay taxes when you borrow the money out. You only pay taxes when you sell the property.
Yeah, or you avoid it altogether if you pass away and your kids get the step up in basis and all that good stuff. So what's funny is wealthy families have been using this type of strategy for like hundreds of years. It's not a new idea. It's just had a hard time making its way down into middle class households because people have been taught to be completely fearful of debt. And what they don't realize is when wealthy families, when they want to raise capital, they don't always do it this way, but it's one of the tools at their disposal is rather than selling a portion of the business that they built or a portion of their real estate or something, they borrow against it and hold on to it. And they do that for two reasons. One is the most obvious one is that it's significantly more tax effective to do that. And the other reason is in many cases, those assets for wealthy families aren't liquid. Right. It might be a restaurant that they've built up over the years and they don't want to sell a portion of it and give up control or pay the taxes. So like Elon Musk, not to go down a political route because he's kind of a lightning rod for political conversations lately. But when he bought Twitter, he didn't sell Tesla stock to do it. He borrowed the money.
Against his Tesla stock.
Sorry?
He borrowed against his Tesla stock.
Yeah, because that's a game that they've been playing for years, and it's a legitimate way to use the money. You're making something that's illiquid or something you don't want to give up control of. You're making it liquid by borrowing against it, and it has tax ramifications in a good way.
Famously here in LA, we have a family that, the good news is the value of the asset went up so much, the Los Angeles Lakers, that when the owner passed, and he had, I think, 3 siblings or three kids to divide it to, and I think there's a 4th heir as well. To divide it in 4 pieces is difficult. How much cash do you have? And it went up so much to the valuation being $10 billion to give 3 kids each $2.5 billion. That's a hard loan to get. You can't walk into B of A or Wells Fargo get that. And there's no reverse mortgage there, but that shows the challenge. Now they sell the asset to pay it out. And in real estate, oftentimes families find they have one sibling that needs to get paid out. Well, the reverse mortgage can give the liquid assets to get the process going before they pass even, and that creates some liquidity. So talk a bit, when you as a professional, I know your job is to develop relations with, through CrossCountry Reverse Mortgage Department. Are they signing on as affiliates or are they signing on to refer business to your professionals? What's the relationship between a financial advisor and CrossCountry?
Well, the way I think of it, like financial advisors are, what people think of their financial advisor as is sort of like a CFO for a household. At least that's the ideal relationship that a financial advisor wants with his or her clients. And I think to myself, like the CFOs that I know, they manage both sides of the balance sheet, not just the assets, right? Clearly the real estate choices that you and I make as adults and husbands and fathers, I mean, I don't know what your family situation is, but like we have to make real estate decisions because we have to have shelter. And these have a huge financial impact on our lives. And yet a lot of financial advisors don't really talk much about that. Sometimes it's for compliance reasons, sometimes because they haven't been trained, sometimes both. And I'm not saying that there's some evil conspiracy where, trying to keep those industries separate, but they're separate. And so what I'm trying to do with our team is to help us be a resource for financial advisors because financial advisors need relationships with people that can handle the other side of the balance sheet, the liability side of the balance sheet, because that's hugely important for people. We're talking about 6 and sometimes 7-figure financial tools that financial advisors have a little bit of a minefield to walk through to talk about compliantly with their clients in a lot of cases, but they need those resources. Their clients need those resources for their financial health, and we're trying to build relationships to help them have access to those tools. And the knowledge how to implement them and integrate them into the financial plan in general.
And when they don't have liquidity, they have to pay a tremendous penalty of some sort, excess taxes or selling at a discount when they otherwise wouldn't want to, versus when they have liquidity. I'm in a large estate right now I'm working with, and fortunately we have about $40 million of liquid assets. And there's a problem on a loan that was called due because the decedent passed. And I guess there's a provision that allows banks to call loans due. I didn't realize this in commercial loans. because he guaranteed it. He's passed, even though his assets are still there. And fortunately for us, the administrator said, "Fine, I'll just pay it off. I've got an extra couple $1 million in this account. We'll just pay it off. We don't need the loan that bad." All of a sudden, the bank said, "Whoa, whoa, whoa, whoa! We'll refinance it. Well, we want to work with you." No, we're just
really want that, yeah.
yeah, no, we'll just write you a check. Thank you. I'll be gone with you. But in many cases, the opposite. If the opposite was true, and there was a time when everything was tied up in this estate, that what do we do in order to raise $1 million? Well, we sell a $2 million property and hope we get $1.9 million on a quick sale price because we need the money right away. We can't fully market it and wait to get a $2 million price maybe if you have to close in 30 days or something like that. So that's where these things come into play. So let's talk a bit about how do you contact and develop relationships, or is a company creating relationships and you're nurturing the relationships? What's your role from the advisors that you work with on a day-to-day basis? What's that look like?
Well, we typically meet financial advisors through offering CE. And the way we do that is we just lead a discussion about here's how this works. And it's a financial tool that your clients are bound to ask you about. It's getting more and more popular. And a lot of the thought leadership in the financial planning world is starting to tell financial advisors, in their publications, I'm talking about like Dr. Wade Pfau and Barry Sachs and Jamie Hopkins, like they're the thought leaders in that space. They're telling financial advisors, this is something you should probably understand because you can't just ignore the value of somebody's home in their financial plan if you're calling yourself a financial planner. That's a big asset. You can't just ignore that.
Right.
And so, the way I see it is financial advisors over the next 10 years are going to have relationships with someone that can do reverse mortgages. And, we want to be the ones that are helping them connect those dots earlier than later, because a lot of people's, financial well-being is at stake. So we do a lot of those presentations through CE classes where I go through, or I'm not the only one that does them, but we have a group of us that do these CE classes, and we just kind of explain, here's how it works. Here are the upsides, here's the downsides, here's the costs, here are the limitations. And the main point that I try to make in this whole conversation, and I've mentioned it before, because it's really quite simple, you're just making the equity liquid. And the fact that it accrues interest is normal because you still own the asset. And so that's an okay thing. Wealthy families have been doing this for generations and generations. And what financial asset can you imagine that you would choose to be illiquid over liquid? Let's say you have money at the bank. So sometimes we'll talk about this and people will say, yeah, but I don't want to spend my home equity. And I think to myself, well, that's not really the point. Like, you may need to, A, or B, maybe you don't ever need to, but can you imagine if you went to the bank and you needed your savings and you didn't really want to spend your savings, but you ended up needing to, and the bank said, oh, sorry, that's not liquid. Like, that's not acceptable with any kind of wealth when we have the ability to make it liquid, to keep it illiquid. That doesn't make any sense.
A classic case also, I just experienced a client who mom is a widow and getting on and lives in LA, kids live in Las Vegas. They want to move mom to a care facility in Las Vegas market. So they take their time and get the house in the market. They move mom to their house temporarily, thinking they'll clean up the house and sell it. And along with 15,000 neighbors, the house burns down. And they owned the property free and clear. In their mind, it was worth at least $2 million, and they could sell it easily because it was a hot market in the Palisades. Well, it's so hot it burned up. A. B. With insurance is dragging on to pay the full claim. They're advancing quickly funds for emergency situations of living, but not for settlements. The settlements are well below market, and now these prices are dropping in value. And so, had they had a reverse mortgage for $500,000, they could just write the check and pull the money out. Who imagined that would happen? Nobody. But isn't that the job of the advisor, to prepare for the unforeseen possibilities? And now they're sitting there saying, how do we get a hold of mom's money? It's going to be, who knows, 6 months, a year? I mean, nobody really knows the answer to that question. And so that's a case where, like you said, it's not that you need the money, it's that you need to know that you have the access to money in case something comes up you never imagined. And that's why we have those kind of unimagined situations.
Yeah, people talk about pardon me, Bill, go ahead.
No, that's all right.
When people talk about reverse mortgage costing, more money than a traditional mortgage. That's usually true, right? There's that insurance policy that you have to pay for, depending on the type of reverse mortgage. There's a couple of different types, but the most common one, the FHA insured mortgage, there's an extra cost to that when you get it, and that is one of the main reasons. So my brother is a CPA. He and I wrote a book about reverse mortgages, and we literally called the book "Reverse Mortgages: The Financial Ugly Duckling," because people are so tempted to compare it to something that they're familiar with, that they understand, and that they know. And yet it really deserves to be analyzed on its own merits by itself, because it is a unique financial tool. So like the feature that you're talking about, where you have this line of credit on your home and something happens to it, or you need access to it, or you just need temporary access, you need some funds, you can take it in and pay it back. Like, it's this open-ended line of credit where you can, if you pay it down, you can reborrow that money back if you want to. It's a really beautiful financial tool. And if you're expecting that kind of tool to do to cost differently than a traditional mortgage, well, you're right. It isn't a traditional mortgage. It does something completely different. And the fact that it's insured and guaranteed regardless of the value of the house, your line of credit is still growing, which is something we haven't even mentioned now, but people who are listening to this podcast probably know that. It's almost when I do the presentation, most of the time, there comes a point in the presentation where people's alarms start going off in the back of their head, which is the too good to be true alarm that we all have. And it's like, how does this financial tool possibly do that? And the answer is, well, it's that insurance policy that makes all of this possible. So yes, it costs some money to have that in place, but it does something that no other mortgages will do.
I think of I'm not selling the mortgage. I'm not an originator. I'm just a real estate broker who works with mortgage originators, and wish more of my customers had this product or thought about this product. I think everybody who buys a house and owns a free and clear should get the line of credit, the HECM line of credit on their property, if not advance money. I think of this mortgage as like a Swiss Army knife. A Swiss Army knife is not a very good knife. I have other knives that are much better for various purposes. I have a steak knife. I have a cutting knife for a pocket knife for defense purposes. It's not a very good screwdriver. It has a Phillips head, a flat head, a this, or that. It's a great Swiss Army knife because in a small package it has all these things. And I think the reverse mortgage is the same way. It's not a great forward mortgage. It's not a great line of credit in of itself. It's a great multiple tool that if you make it fit for your needs can be the best tool or not. And you need to evaluate that, I think. And this is the thing I'm leading all this up to, which is you mentioned a couple times, the reputation of the product. I was involved with this product when it first came out. I call it Reverse Mortgage 1.0, when there was a lot of dishonesty and a lot of wild things done. And that caused the product to be highly regulated. And then what's now I call Reverse Mortgage 2, I think unfortunately still suffers from the stench of the first time around. Financial planners and financial advisors and attorneys and accountants tend to be a little older and remember that. And I think also the stench of servicing issues. Now, I only interview originators who are great originators, and they take care of the customers after they close their mortgage. Those people go onto the phone service bureaus, often have bad experiences because those companies don't have good service. That's why they have to advertise on television. And I would say, let me introduce you to a great mortgage originator. He'll take care of you. So talk a little bit. You must get pushback from people who don't know why they know it's bad, but they know it's bad. And I would say it's either the stink of the first product or it's the stink of the current servicing. And then how do you address that?
I actually think it's something else, Bill.
Oh,
I think we often attribute it to that. And I actually think our industry does that it's a mistake to do that. So like there have been unscrupulous, easy for me to say, lenders. And you could say that about any industry, right? There's unscrupulous attorneys and accountants and everything.
Not realtors, every other industry though, yes.
Yeah, except for realtors, of course.
Thank you.
So what I think is the foundation of all the misunderstanding and all the negative stigma, and it's not that it hasn't been adjusted over time. Things have been updated and that's great. But I think the biggest source of the confusion and the stigma is that it creates an emotionally misleading, it's got an emotionally misleading financial concept at its core, which is borrowing the money. But the way that I address this is think about, so let's say you've got a family that wants to go on a 50th wedding anniversary, right? We've got this big extended family. Mom and dad want to pay for the whole trip. And let's say in this example, they can afford it. So there isn't a question of unaffordability. They've got some assets that they're fine. And they decide to budget $50,000 for this big trip with plane tickets and cruise tickets. And they're going to celebrate this big 50th wedding anniversary party. If they sell $50,000 worth of their investments to pay for that party, and let's say that account went from $500,000 down to $450,000, right? $400 or $50,000 less. if that account doubles over the next 10 years, is anybody who thinks this through not understanding that they are $100,000 less wealthy 10 years from now because they went on that trip 10 years ago and spent $50,000?
Or more.
That's clear. If it would double in that amount of time, then they are $100,000 less wealthy because they did that, and nobody faults them for doing that. That's just how money works. By the way, that's how, if you spend $10 on lunch today or $20 on lunch today, that's $40 you won't have sometime in the future if you had invested it. But is anybody really saying don't ever go out to lunch? No, we all understand that money works that way, and we have to balance the value of the present and the future and all that stuff. But for some reason, if they would have used a reverse mortgage to go on that vacation instead of the $50,000 out of their account, then their account would have remained at 500. It would have grown to $1 million. It would have doubled. But they would owe on their reverse mortgage, instead of at 50, they borrowed at $50,000. 10 years later, they owe $100,000, and that feels ugly because they forget that it's a part of a bigger picture. Because I'm still like at the wealth at the end of that period is still $900,000 any way you calculate it. You either have $1 million on your assets and $100,000 on your liabilities, or you have $900,000 worth of assets and no liabilities. It's the same amount of wealth. But there's no statement on my portfolio. Let's say it doubled from 450 to 900 because I used that for the vacation. There's nothing on the statement that says, hey, Brady, remember that trip you took 10 years ago that was $50,000? Do you realize your account would be $1 million if you hadn't done that? I mean, I know that that's true, but I don't have to face it all the time.
Right.
But if I see in a statement for my line of credit that's grown from 50 to 100,000, if I look at that in isolation, that feels ugly unless I remember that it preserved for me $10,000 or $50,000 10 years ago. That is now $100,000 that I wouldn't own, which is, again, why wealthy families do this. It's just another strategy of where to get assets when they need them. And I think they have a little bit of an advantage besides the wealth in that they have people working for them that help keep them a little emotionally separated from their money. Because seeing a liability go from $50,000 to $100,000, it's easy to look at that and say, holy cow, I owe $100,000 for that $50,000 trip I took 10 years ago. And it's like, well, I know that's emotionally difficult, but that's the same as if you'd spent the money 50 grand 10 years ago. That's hard for people to digest.
I think, yeah, and you add to that the mistaken idea, well, if I owe the money and can't pay the mortgage, they'll take the house away from me, which is never going to happen with a reverse mortgage, as long as you pay the taxes and insurance, or HOA dues or whatever else you need to pay. But the mortgage is not going to take away the house because you don't have to pay it, unlike a regular mortgage. You never have to pay it. That's the beauty of it. You can. You don't have to. Okay, so that's an interesting idea. So you have a whole different perspective on this I'd never really considered. And I can't solve that one. I can solve the stench of 1.0. We're talking about the changes in regulations, and I can solve the lack of education by having this podcast. But what you're talking about really requires a professional to kind of explain to their customer and show them on a piece of paper, hey, this is where this is your full financial statement. All we're moving is from here to here. Either you're going to lower this by $50,000, which over time will reduce your appreciation of these assets, or the $50,000 is going to go here, and it'll be a $100,000 mortgage, but you have the $100,000 more assets here, and so it needs a professional to do that.
Well, if you think about it, it's like, so selling an asset and foregoing all of its future growth is fundamentally the same thing as keeping the asset and borrowing against it. Fundamentally, that's the same thing.
Except you pay taxes when you sell the asset, perhaps.
Yes.
And you don't if you are against it. That's the and one thing about people who are wealthy, man, they figure out how not to pay taxes. I'll never forget. Well, I won't get into the politics of it, but yeah, definitely wealthy people figure it out. They spend more time not paying taxes than I think they do once they're wealthy, and they can use that to their advantage over and over again. It gives them a chance to do things the rest of us couldn't do. Wow. Yeah. Okay, so let's talk about a practical level. You offer CE classes for financial advisors. Do you offer to the public? Do originators in your company set up these classes and bring you in as the talent? What's mechanically, what does that look like?
It happens all sorts of ways. So I do a lot of them actually that are one-on-one. In fact, I encourage our team, like if you could get an hour with a financial advisor and talk about what you do and talk about how this product works, would you take that hour? And the answer is always, yeah, that would be a great opportunity. So when we do CE, it isn't always to groups of 30, 40 advisors. It can be, but I recommend very strongly to our originators, I say, if you want to set up a CE class with one advisor or maybe a small team that works together, do that. I'll Zoom in, you go there in person, we'll talk about it. And by then, I'm telling you, I'm not even rounding. I'm saying 100% of the time, financial advisors is when they invest the time to learn how this works. I don't think it's because I'm a great presenter. I think it's because once people realize how this tool really works, it's like, why don't more people do that? It's like, well, we're working on that.
That's the thing that got me into this. I started this whole thing. This is we're filming this now in June. I started this last year in December on a file where someone explained to me the reverse mortgage HECM for purchase, and why you shouldn't pay cash to buy a house if you can pay cash. Why you should get the maximum purchase you can get, save those assets. And he went through the numbers, and I thought, how do I not know this? I'm a real estate broker. Now, I don't work with buyers often. I don't work in a senior area in particular. I'm in West Los Angeles. I don't work in a vacation area like Florida where I deal with people with second homes and such, or moving. Here's the pathetic part. I was looking to buy a home in Florida. I like to move to Florida. I lived in Florida before I lived in California. I was married in Florida. But we're not going to. My wife and I have our grandkids here nearby. And so I said, well, what if I could buy a house there, call it my residence for tax purposes? I'd say it would be almost free if I did that. How much can I afford to pay cash for a home when I'm keeping my current home? I can't use the equity, and I still have to pay for the home I have now. But I'm going to move my residence and my business. And so I had about $500,000 of excess money, which isn't really a lot or enough. And I was looking, I was frustrated. And then I talked to a originator. They may have been CrossCountry, actually, when you think about it. And they said, well, why don't you get a HECM purchase? I said, what do you mean? He said, you can get an $800,000 house, get a $300,000 HECM, and a $500,000 cash, what would be $800,000, and it just opens up more. And I saw that. Now, the truth is, my wife's not letting me. So it's like a fantasy. I'm like imagining some girlfriend or something. But the idea that paying cash, you can get 30% more, really without any extra monthly payment, was just. And I'm a real estate broker. How do I not know this? Now, you're not in the real estate broker education piece. Your company is. Your company works with virtually every great real estate agent in the country. So hopefully this video will help them, encourage them to go out and educate their realtors.
Well, I do a lot of CE for realtors as well.
Oh, wow.
Yeah.
Wow.
I mean, I was 20 years of financial advisor, but our presentations are typically for realtors and financial advisors. Right. And I think, like what you're saying, in another aspect that I see is people who can afford to pay cash for the house they want. It's the house they want, and they could afford to pay cash. Right. And I would still jump in the middle and say, no, don't do that. You want that liquid, and they might say, well, yeah, but I can just get a reverse mortgage if I need it, when I need it. And my response to that is, well, yes, but it's going to cost you more, and you're going to get less if you do that. And second of all, and this is important, this is really important, and this gets overlooked by real estate agents, financial advisors, accountants all the time, is that if you buy a house with a reverse, the interest that it creates, the interest that accrues, is as deductible as any other mortgage, if and when you decide to pay it. Well, not when, it will get paid eventually when you sell the house or when you pass away. That creates massive 1098s, and those 1098s aren't deductible if you take it as a cash out withdrawal. It's only deductible if it's used for purchase debt, right? Acquisition debt or improvement if you use it to improve the home. So if you buy the house cash and then take the money back out later, the interest that creates isn't deductible. The IRS doesn't allow that. But if you buy the house with the reverse mortgage, that interest is deductible. And we're talking about massive 1098s for like 6-figure 1098s that become deductions. It's insane what can be done on a financial planning and tax perspective that is just going right by financial advisors, because they're not typically trained on loan products. It's not their fault. I don't think there's some evil conspiracy, somebody twirling his mustache, trying to keep these industries separated, real estate and finance. But there's a lot of overlap here that we can use to help our clients' lives if we just connect the dots and do it for them.
Well, and for real estate agents, often an exit strategy is a really big deal. In my case, I also flip some properties. I have a really big one closing now. I'm going to have a large tax liability this year because I have a good income year, a good business year, and a large, for me at least, large flip. Well, that creates a kind of a surge in taxes that, had it been, in Florida 2 years ago, I would avoid the California portion, but I still the state portion. Well, if I had the reverse mortgage, I might use this as the year to pay down all the interest and take the deduction on the interest this year, because I don't have that interest deduction maybe other years. So it creates some options that, as you look at your finances, it just creates options. Like I said from the beginning, it's not a great knife, it's not a great flat screwdriver, it's not a great Phillips screwdriver, but it's all three in one little package on my desk. That's why it was Swiss Army knife, and I think that's why everybody should look at a reverse mortgage. And if you're a financial advisor, look at the product. And then I think one way to do that is obviously reach out to your CrossCountry Mortgage reverse representative to try to set up an appointment, and or reach out to Brady directly, I guess. And I guess, do people reach out to you and then you refer them to a originator? Is that part of the process?
Yeah, depending
also?
on where they are, and if they want to meet with somebody in person, we've got people all over the country. Or yeah, I just connect them with our lenders. So I don't do loans personally. I'm here in a different capacity.
Well, if somebody wanted to reach out to you and talk more about that, I have, I think up on the screen right now, your contact information, 720-285-8050, and your email is brady.mullen@ccm.com for crosscountrymortgage.com. I know them. I've worked with them as a company for quite a while. I know a lot of originators there, as well as management. Great company. And Brady, I'm really... I'm trying to think who put us together. Somebody was nice enough to reach out and say I should reach out to you, and made you available to me. So
I'd love to know who that is. Yeah,
I owe somebody a thank you. But in the meantime, until then, let me just thank you personally for being on today, taking time to educate us, and then offering stuff to other people going forward. I really appreciate your time.
Yeah, you're welcome, and thanks for reaching out. And I would highly encourage people to connect with me on LinkedIn. I try to post about 3 or 4 times a month some topic about where real estate and personal finance come together, and yet financial advisors can't really talk about it for compliance and legal reasons, and real estate agents and lenders aren't their job isn't to see the whole picture and make financial plans for people. So I put a lot of content out there about the importance of making the right decision from a real estate perspective and how it affects your overall finances. So I spend a lot of time thinking about that stuff and trying to make things clear.
And for realtors originators who are looking for content for your blogs and for your video topics, take one of Brady's talk about, link to him, and there's a great source of information as well. So thank you so much, Brady. Thank you so much for your time today. I really appreciate it. It's a pleasure talking to you.
My pleasure. Thanks, Bill.
And for the rest of you, this is the Reverse Mortgage Podcast. We get together and every week issue a new episode with usually top reverse mortgage originators, sometimes management. In this case, really a great resource, I thought. I hope you found it helpful to teach us a little bit how to be more effective in our job serving our customers using reverse mortgage or integrating it into the rest of their package with our advisors. If I can help, please reach out. I'm at Bill Gross Probate on social media. If you like this episode, like it, comment, subscribe, reach out if I can help in any way. If you'd like to be interviewed or know somebody who should be, feel free to make a suggestion. As always, make today your best day ever. Thanks so much.